Cash flow is king, and dividend investors know it better than anyone. One thing's for sure, if you've ever seriously looked into dividend ETFs, you've definitely come across this one. I'm talking about none other than Europe's most popular dividend ETF, the Vanguard FTSE All-World High Dividend Yield UCITS ETF. In today's video, we'll break down the key pros and cons of this ETF, short, sharp, and to the point. I'm pretty sure there are a few details here that not everyone has on their radar. And if you're investing for the long term, you really need to know exactly what you're buying into. Full disclosure, I'm personally invested in this ETF, but that doesn't mean I think it's perfect. Quick disclaimer before we dive in. This is not financial advice, just my own opinions and experiences. All right, let's get into it. We'll start with the pros. Total return. Since its launch in 2013, this ETF has delivered an average annual return of around 8%. For a dividend-focused ETF, that's solid. And if you look at the chart, you'll see that performance comes not only from dividends, but also from price growth. That's something I really like, because many dividend ETFs tend to just move sideways over time. Diversification. With more than 2,000 companies from all over the world, this ETF offers ultimate diversification. In fact, it's the broadest dividend ETF you can buy in Europe. The country allocation looks solid, and yes, even emerging markets are included. Such broad diversification helps you stay calm during hefty market corrections, and even gives you the confidence to keep buying. Dividend yield. The average yield sits at about 3.5%. Not mind-blowing, but still respectable. Dividend consistency. Payouts have been steady, with only moderate cuts in tough years. And that's one of the reasons I really value this ETF. Popularity, fund size. With nearly €6 billion in assets under management, this is the largest dividend ETF available in Europe. The fund keeps growing, which means you don't have to worry about it being shut down or changed. In other words, this is an ETF you can hold forever without worry. Costs. At 0.29% per year, the fees are reasonable for a globally diversified dividend ETF. And who knows, Vanguard has a history of lowering costs, so maybe we'll see that here too. In fact, Vanguard has recently reduced fees on some of its ETFs available in Europe. ETF provider. It's Vanguard. They're known for reliability and investor-friendly management, and as one of the world's largest asset managers, they have decades of experience running index funds and ETFs. Core investment potential. Put it all together, and this ETF works beautifully as a core dividend holding. A hands-off, worry-free investment you could hold for decades. All right. But there are a few downsides we need to talk about too. Let's move on to the cons. No quality filters. The ETF's composition is very simple. Any large or mid-cap company that pays a dividend gets included. Because there are no quality criteria, some bad apples end up in the portfolio. Companies with weak share performance or no dividend growth. By contrast, other ETFs, like the VanEck Morningstar Developed Markets Dividend Leaders ETF or the Fidelity Global Quality Income ETF, apply stricter filters, so those weaker companies wouldn't even make it into their portfolios. Dividend yield. Yes, I've listed this as a pro. A 3.5% yield is decent. But let's be honest, most of us would prefer 4%. Or even 5%. Still, A yield of 3.5% wouldn't be a problem if there were strong dividend growth to go with it. Which brings us to the next point. Dividend growth. In my view, this is the ETF's biggest weakness. Dividend growth of just about 3% per year is very weak. At that pace, it would take roughly 25 years for the dividend to double. Far too long. Put differently, 3% a year barely keeps up with inflation, which means your dividend purchasing power never really increases. In my view, healthy dividend growth should be at least 7% per year, and that's only possible when the fund applies quality filters to the companies it includes. No REITs. Don't ask me why, but real estate investment trusts, which are normal stocks after all, are excluded. So we miss out on a high-yielding opportunity here. Last but not least, small emerging markets exposure. There's not much to see here from China, India, and other emerging markets. Just like with its big brother, the Vanguard FTSE All-World ETF, the share of emerging markets is under 10%. So while the fund is global, it's still clearly weighted toward developed markets. So, those are the pros and cons. Despite the drawbacks, I really like this ETF and plan to keep adding to my position, especially during market corrections, when the yield gets more attractive. Do you already hold this ETF in your portfolio? Drop a comment below and let's compare notes. And of course, don't forget to like, subscribe, and hit the bell so you don't miss the next video. Thanks for watching, and I'll see you next time.